What's up, bosses? It's your boy Lube of Wall Street. Per the request from a few female subscribers, I'm actually using my own, albeit modified voice today. Again, my channel is about serious investing. In today's video, we're gonna discuss the Chinese stock market. More specifically, why you absolutely need to invest, or at least planning on investing in the Chinese stock market, and how you can invest there. I will also give you one of the top A-share stock picks by my investment partner who does deep dive local researchers in China. So why do you need to invest in the Chinese stock market right now? First reason, China is where the next party is. As discussed in my last video, which you will find the link to at the end of this video, the party in the US stock market could be almost over. Because the near-term growth driver in the US, due to the pent-up demand and physical stimulus, is actually saturating and not sustainable, while the mounting inflation pressure will soon force the Fed to raise interest rates. However, unlike the Western countries, the recovery and growth coming out of the pandemic in China is actually not reliant on aggressive monetary or physical policies. Instead, the recovery in China has been driven by disciplined virus control and smart adoption of digital technologies, which is much more sustainable than the US. Looking ahead into longer term, as many know, the Chinese economy is projected to grow 40 to 50% in the next 5 years, bolstered by supportive environment for disruptive innovations and swift transformations. So the party in China is actually pretty real. Moreover, with the short-term interest rate in China currently set at 2% versus 0% in the US, the Chinese central bank PBOC actually has a lot of monetary munition to further stimulate growth, thus pump the stock market when needed. With the continued progress in the bad debt restructuring efforts in China, I personally think the PBOC is very open to monetary easing, which will be a source of upside for the Chinese stock market going forward. So the takeaway is that while it is increasingly difficult to find hot chicks in the US stock party, there are just many single sexy girls wandering around in the China stock party, which is just warming up. Second reason, the Chinese stock market is a great source of diversification for a US stock portfolio. Simply because what is happening in China and Asia is just different from what's happening here. Hence, the fundamentals in China actually uncorrelated to those in the US, resulting in the diversification benefit I was referring to. In a nerdy microeconomic sense, China is in a different stage cyclically and a competing position secularly as compared to the US, which makes its stock market a great source of diversification. So cyclically, as we just discussed, China is at a different point of its credit cycle, with the activity level there projected to be slightly below the output potential for the next year or two, while the US economy is projected to be well above its potential very soon. And secularly, as we all know, US and China are the two major competing players in the ongoing technology revolution. These two big boys are constantly wrestling on this front. While the US is still the leader in most technological areas, China is quickly catching up in many emerging fronts. It is probably still too early to tell who is going to be the winner after all, or if there is even going to be a winner at all. But it doesn't hurt to start hedging your risks, hedging your portfolios with exposure in Chinese tech stocks. Many US investors have expressed to me personally their concerns of risk investing in the Chinese market. But let me tell you what, sometimes the biggest risk you can take is not taking the risk you should have taken. In this case, it may just be investing in China. And just to share a personal story, I don't think my wife would end up marrying me if I didn't take the risk of sexually assaulting her back in college. So GG. Number 3, global institutional money will be flowing into the Chinese market, and bro, we need to get ahead of the trend. Guys, just take a look at this chart. It shows how underweight global investors are in the Chinese market. This was partially due to the restrictions China has had on foreign investments. However, as the Chinese government actively opens up its financial market through the dual circulation initiative, and foreign investors increasingly look to diversify their equity portfolios and hedge USD currency risks, global institutional capital will soon flow into China. Okay, enough said. Here is how we can invest. Number 1, a convenient way to invest is just to buy Chinese ADRs in the US, Chinese companies listed in the US, or China ETFs traded in the US. While these definitely give you the fundamental exposure to China, but their performances are actually also driven by the sentiment or risk premium changes in the US market. So your exposure through these investments is actually not that pure. Also, the Chinese stocks listed in the US are mostly mega cap tech names, so the fundamental exposure you can get is rather narrow. Number 2. Another convenient way is to invest in H shares traded in Hong Kong or China ETFs in Hong Kong. But similarly, these investments are also driven by the sentiment or risk premium changes in the Hong Kong market, which tracks the US equity market because of the HKD USD tagging. Also, the fundamental exposure you can get is somewhat limited in this channel, as many deep value Chinese companies are actually not listed in Hong Kong. Number 3. You can also invest directly in China A shares, which definitely give you the pure exposure to China, also unconstrained fundamental exposures. If you are Chinese investors who live in the US, I highly recommend you to buy A shares. If you're a foreign investor though, this may be a little difficult as you can only buy China A share through these 3 programs listed here. These programs currently have a lot of restrictions, quotas, and likely require you to be an institutional investor. Therefore, it comes number 4. I personally think the best option is to invest in a professionally managed fund which conducts in-depth local researches in China, directly invest in the Chinese local market, and is highly accessible by the individual investors in the US. For example, CraneShare is a great institution which offers a lot of relevant funds like this. Please check out the China thematic and China core ETFs on their website. My partners and I are also working on creating diversified funds investing in the Chinese local market and open to US investors. Hopefully, we'll have some exciting news for you soon. Last but not least, as mentioned earlier, here is one of the current A-share top picks from my investment partner in China. We think the stock has underpriced fundamentals and is also ready to make a move from a sentiment standpoint. That's it for today, folks. If you like what you hear, please subscribe. Peace out.